I'm 22 years old and I'm invested in real estate. This video will tell you how I did it, how you can do it too, and how anyone can start investing in real estate for very little money. Hi, I'm Evan and let's talk about what real estate actually is. Real estate is an asset class that's made up of different types of things that you can invest in. Generally, we break up real estate into two categories, property and REITs. Property is essentially physical real estate. This is the ownership of physical buildings, homes, and land. If you've been watching the news lately, you know how hard it is to own property nowadays. There's roaring inflation, home prices are only increasing, and interest rates are going up. Plus, you need a lot of money to buy something like a house, even with a mortgage loan. And being approved for that loan assumes that you already have a historical and steady source of income, and a good credit score, which not everyone my age is going to have. Not to mention, being invested in physical real estate is just tough. You'll need to have the knowledge and the connections to scout out profitable properties. You'll have to deal with ongoing maintenance and repairs, and you'll have to be a landlord who collects rent, which can be a demanding job. These facts about investing in physical property are a lot different than how people normally talk about it. They'll say that buying real estate is a great way to make passive income. This ignores all of the active work that it takes to buy the property, maintain it, and then continuously collect rents. So if you actually want to passively invest in real estate and make passive income without doing all of the work, what can you even do? You can invest in REITs, another category of the real estate asset class. REIT stands for Real Estate Investment Trust. REITs are companies which own, operate, and finance income-generating properties for a group of investors. They're actually very similar to mutual funds and ETFs. With those types of investments, they pool money together from a bunch of different investors to have a lot of money on hand in order to buy large investments. The difference is that rather investing in stocks, bonds, and other types of assets, REITs are exclusively focused on investing in real estate. There are certain things that companies have to do to qualify as a REIT, as we'll talk about later. The beauty of REITs is that they allow individual investors like you and me to invest in real estate, generate passive income from the dividends from rent collection, and see increases in equity values without having to finance, buy, and manage physical properties on our own. REITs let you truly become invested in real estate passively by doing all of the hard work for you, and they still give you a consistent cash payment. Like ETFs and mutual funds, most REITs are actively traded on public markets. This means that it's just as easy to invest in real estate through a REIT as it is to own a piece of Tesla by investing in its stock. Because REITs are actively traded on public markets, this actually gives them an important advantage over physical properties. They have more liquidity. This is a measure of how easily something can be bought or sold or essentially exchanged for cash. With a physical piece of property like a house, there's a lot of work that goes into making the sale. Rather, REITs can be bought and sold on the market just as easily as any other stock. This means that it will be easier to sell REITs and thus make a profit as compared to physical property. The general idea with REITs is that they collect rents on all of their different properties and then give out this money to shareholders in the form of a dividend. But how does a company qualify to be a REIT? First, the company has to have 75% or more of its assets tied up in real estate, cash, or government bonds. Next, they must make at least 75% or more of their income from rents, interest on mortgages on physical properties, or selling real estate. Most importantly, they must give out at least 90% of their taxable income as dividends to shareholders. There's a few more rules in place to create transparency and accountability for investors, but they're not as important for our purposes. What is important is the cash payout through dividends. REITs make the money for these dividends through two types of activities. REITs can be placed into three different categories based on which activities they perform. First, we have equity REITs. They make their money primarily by owning and operating physical real estate. Revenues mostly come from collecting rent. Second, we have mortgage REITs. These make their money by providing mortgages and loans to other real estate investors and operators. They also deal with mortgage-backed securities, which you're likely familiar with their involvement in the '08 housing market collapse. They make profits from the difference of the interest rate that they charge others and their cost of funding the loan. This means that equity REITs are more sensitive to increased interest rates, as we're seeing the Fed do now. The last type of REIT is the hybrid REIT. These deal in both collecting rents and issuing mortgages. There's really no best type. It depends on your personal risk tolerance and goals. Though given the somewhat predictable increases in the interest rate over the short term, equity REITs may make more sense in the moment. We can also classify REITs by how they can be bought and sold. We have our publicly traded REITs, which are the ones that are available on the market that you can buy like stocks. Then there's public non-traded REITs and private REITs. These are traded off of public markets and they require you to be an institutional investor in order to invest in them. This just means that you have to meet certain qualifications of being worth a lot of money or making a lot of money. Both of these types will have less liquidity than normal REITs, which make them riskier. Now that we've broken down what REITs are and how they work, let's go over the pros and cons of investing in REITs. The biggest reason you might want to invest in REITs is for the potential for long-term growth. Assuming you reinvest your dividends, REITs have actually come close to the performance of or even exceeded the stock market as measured by the performance of the S&P 500, depending on the time frame we're looking at. In contrast, the actual share value growth of REITs is low. If you just pocket the cash and don't reinvest it, then your returns are going to be much lower. This is true of any investment, stocks included. But generally, REITs are going to grow slower than normal companies. This is because REITs have to pay out 90% of their taxable income to the shareholders. Unlike other companies. This means that REITs can only use 10% at most of their taxable income to reinvest in new ventures or to improve the business. This severely limits short-term growth potential because REITs can't take on large projects as easily as other companies. But we're more so worried about long-term growth potential, and REITs can offer that since property values tend to increase over time. Another pro of REITs is their liquidity, like we talked about earlier. Because public REITs are traded on the markets like stocks, you can very easily buy into and sell out of your stakes in these companies. This makes it much easier to realize profits and see cash from your real estate investments versus having to sell a physical piece of property. As a con, the cash dividends you receive are going to be taxed as regular income. One way to avoid this con will be to invest in REITs through your tax-advantaged accounts. These give you special tax benefits on your investments, such as not having to pay regular income taxes on your dividends now or at all. A great pro of REITs is that they give you very easy access to portfolio diversification. When you invest, you want to invest in a couple of different things. This keeps you from putting all of your eggs in one basket. If you drop your basket or a single investment tanks, well then that's all of your money gone. So while I have a very S&P 500 index heavy portfolio, I am diversifying by investing in real estate through REITs and alternative investments like crypto, though not that much. Diversification is especially important in times like these. We're seeing growing market uncertainty and interest rate increases, which are only pushing stocks down, potentially into recession territory according to some. Real estate is often seen as a good hedge for downturns in the economy because property is essential. People have to live and work somewhere. But as a con, in contrast to this diversification, REITs are also subject to market risk. Like we talked about with the mortgage REITs, they don't perform as well when interest rates increase. This is because the cost to borrow money increases, which then lowers their potential profit from offering their own loans. And in general, the housing market is somewhat separated from the stock market, though they are of course both linked to overall economic conditions. People think that both real estate, especially home prices, and stocks are both bubbles close to bursting right now. A good pro of investing in REITs is the provided transparency. Like publicly traded companies, REITs are required to have a board of directors or trustees and to not have the majority of their shares held by a few people. Publicly traded REITs also have to issue financial statements like normal companies. That way you can look at the assets they own on their balance sheet or learn how they make their money through their income statement. But unlike owning stocks in a regular company, REITs have a con of charging you potentially high management and transaction fees. A management fee is what the company charges you for running the business. Many mutual funds and ETFs have these. They compensate the people who actively run or manage the fund. Then there's transaction fees for buying into a particular REIT, though these have gone away for the most part with online trading. What you will still find though are minimum investment limits. These say that you have to invest at least a certain amount of money into buying shares of the REIT. One that I looked at had a minimum investment of $2,500. That would be nearly half of my entire IRA limit for the year. You can find alternatives to high fees and minimum investments, as we'll see later. Another great pro of investing in REITs is consistent cash payments. This enables you to make very easy passive income since your shares will give you consistent cash, normally every 3 months. You'll also know what the dividends will be. That way you can do some math to figure out how many shares you'll need in order to hit a certain passive income goal. And finally, with the pros, REITs actually have really nice returns when you adjust for the risk. When you look at stock returns, they can look very volatile. That's the up and down, back and forth pattern in returns. We'll skip over the math, but basically you can adjust and compare returns based on how much risk that the investments have based on their volatility. While you might not see the price of shares in REITs increase as quickly as normal stocks, that's alright because they're less likely to go down really quickly. The returns are more predictable, partially because of the cash payments, and so that helps with the risk-adjusted returns. You might like some of these pros and you're okay to deal with the cons. Then how do we get started in investing in real estate through REITs? First, you'll want to make your investments in a tax-advantaged account if you haven't already maxed yours out. This saves you money on taxes, especially with the consistent cash payouts. Then you'll need to pick which REIT or REITs you'd like to invest in. I use Fidelity as my primary brokerage account, so I went with the Fidelity Real Estate Index Fund. This gives me more diversification because it tracks the performance of an index, which measures the returns of all equity REITs and real estate investments. The index fund holds a lot of different REITs, thus giving me diversification. Because I use Fidelity, it also has a low management fee and no minimum investment. You can go with a similar strategy by picking a similar fund offered by your broker, or you can choose something more specific. Beyond looking at single REIT companies, you can also look at sector-specific indexes. I'm not licensed to give financial advice, so this is just my opinion as a casual investor, though I do have a finance degree. I'm looking to buy into indexes focused on healthcare and data center related properties. Healthcare is growing and the demand for it will only increase with an aging population. Cloud storage and computing are also only increasing in usage. I think long term, more buildings are going to have to be built in order to meet the demand for these services. So I see growth potential in investing in these sectors. Now with that, dedicate your mouse to that like button and then click it if you see growth potential in this video. It will invest it in the YouTube algorithm so that others are more likely to find this amazing advice. Please also subscribe and ring the bell if you'd like to be notified when new videos come out every Friday. It's all completely free and it really helps me out a ton. Let me know how I can make these videos and comment down below. Click the video on screen to watch another that you're going to enjoy. enjoy, and then please add some music, some real estate investing, or whatever else it is that you love to your day.